Hello and welcome to another episode of Trust Issues. Today I'm sitting down with Ailsa Craig Marek Poszepczynski, managers of International Biotechnology Trust, to talk about the fund and the opportunities for investors in the biotech sector. Thanks to you both for joining us today.
Thank you. Great to be here.
Thank you. Very happy to be here.
So could you start off with an overview of the Trust's objective and current allocations?
So the investment trust IBT was launched in 1994. So it's actually our 30-year anniversary this year. And it was started really to give UK shareholders access to the whole cross spectrum of the biotech industry, from ideas out of university and seed funded early stage venture companies, all the way up to the mature companies listed on the stock market. And the same is the case today. So we have a venture position that makes up just under 10% of the trust. And then the rest is invested in listed quoted assets, which are predominantly listed actually on NASDAQ in the US. Our objective really is to outperform our benchmark, the NASDAQ Biotech Index, which we've managed to do historically over 1, 3, 5, and 10 years. So that's been a positive outcome. In terms of the allocations, we can, as fund managers, obviously decide on what the allocations are. And we've made a change recently. So Marek and I took over as co-lead fund managers just over 3 years ago now. And at the time when we took over, we were in the midst of the COVID pandemic hype, if you like, and the sector was very, exciting, and we had these new vaccine treatment developments, and there was a lot of retail investment, and we felt at the time that it was a bit bubbly in valuations, and so we allocated more to the defensive cash generating larger companies and tilted away from the mid-cap companies. And right now, we think we've had a period of consolidation, a correction in valuations, and we're doing the exact opposite. So our allocations have changed such that we've tilted the fund more to the mid-cap end of the market. We're very positive on the outlook of the sector at the moment. We think we've had a long protected period of a re-rating, if you like, and things are looking very interesting again. So that's a very brief introduction into our positioning and objectives.
Fantastic. Just one small point on the benchmark that you mentioned. I gather the XBI has changed in terms of its composition recently.
It has, yes. So the XBI was an equal weighted index. So if you had a large company like Gilead and it moved, it would have the same effect as a small cap company. And the effect of that was it was much more volatile and of extreme highs and lows versus the NASDAQ Biotech Index, which was market cap weighted. So Gilead and the larger companies took a larger portion of the index and was a more sort of stable when it moved up and down, etc. So the XBI has now changed in the summer of this year to become a market cap rated index. So it's going to mimic and move much more similar way to the NASDAQ Biotech Index. So we used to use the XBI as a proxy of the small cap interest in small cap biotech and the performance of small cap biotech. And we'll probably drop that now and look for another index really to show our investors how the mid cap market are doing.
Great. Thank you for that. So what do you see as some of the benefits of your basket approach, and is perhaps there a risk that the trust becomes too diversified?
Thank you, Joe. It's a really good question. So when you think about the basket approach, you believe a specific therapeutic area will benefit in the longer run. For example, obesity is one area. One area we also focus in the central nervous system and depression, epilepsy, and other central nervous diseases. We have recently seen a lot of scientific progress there, but it's very difficult to pinpoint a winner at this early stage in the development. So one way of dealing with it is you spread your risks. For example, 5, 10 companies with relatively small investments. That limits, you have liquidity issues, otherwise you have volatility issues. When you put it in a basket, you are not betting all your money on one horse, so you spread that. And as the evolution of the progress of the drug, you see winners gaining traction and you have losers failing. And once that happens, we tend to invest more in the winners because we usually invest in a small proportion in the beginning of meeting a company, and over time they're organically or they prove themselves to us, then we can invest more. So you kind of graduate into our portfolio. And basket approach is just, we have taken it to another level. We just put them in the same bracket of a therapeutic area. And we believe that once you have a clear winner, we probably will drop the basket, meaning that we will sell off the losers and focus on the winners. And historically, that has actually been a winning recipe for us.
Great, thank you for that. Touching on some of the things you've mentioned in passing already, what are some of the most exciting developments you've seen in the sector over the past year?
It's definitely the obesity space. It's front and center of not just healthcare investors, but retail investors and the mainstream media. You can't really have picked up a newspaper in the last 6-12 months and not read an article about these new therapies. At least they're perceived as new therapies. They're actually very old therapies. GLP-1s have been used to treat diabetes for decades, but they've been repurposed and now being used in obese patients on the back of really some clinical data that showed incredible advantage when it comes to cardiovascular events, so strokes and heart attacks, a huge reduction in the risk of those events if you were taking these drugs. So that's been a game changer, because originally people thought that obesity drugs really were aesthetically advantageous rather than clinically. And now we have proven it's actually a clinical benefit. So with this new game change and the market potential being what it is, which is vast, if all obese patients in America were treated with these drugs at the current price, it would cost the same as the whole of the pharmaceutical branded budget. It's absolutely monstrous. So obviously what happens in our sector is biotech have come hot on the heels of this market, recognizing the value with their own versions. And there are downsides to the current GLP-1 drugs, and the biotech companies are currently trying to innovate around those disadvantages. So, for example, a lot of patients are on the drug for a year and drop off for reasons such as tolerability, nausea and vomiting. They may have just lost the weight and thought, I don't really want to continue on these drugs anymore. But obviously the problem with that is they yo-yo back up. There's been a concern that people's body composition will change and that they're losing muscle. And this is quite a problem if you're elderly. We all know that falling is quite a dangerous thing when you're in your older years. So that there are multiple biotech companies out there chasing this market with their improved, inverted commas, version. So I would say that's been the most exciting, most discussed, most sort of innovative part of the sector in recent months.
So staying on that topic for a moment, do you think Eli Lilly and Novo Nordisk are so far ahead that others can't catch up?
Well, to an extent, they have managed to invest hugely in capex. So both companies invested something like $60 billion just to make manufacturing plants to make enough of the stuff. So the problem we've had so far is that the demand is there, vast demand for these drugs, but these two companies haven't been able to make enough of it. And there's actually been shortages. So in that sense, they've had a head start on building manufacturing plants. And this is a bit of a barrier to entry, I agree. However, some of the new approaches, things like oral GLP-1s, which should, in theory, be much easier to manufacture, quicker and cheaper. So one aspect of the next generation of obesity drugs is making larger volumes for a smaller price. And the reason is because GLP-1s are a peptide, it's a protein. You can't just make it synthetically at the moment. And that's why there's this huge investment. So I think you're right in that another company would have to match that manufacturing capacity to some extent. And that could put a bit of a delay, a barrier into the market, but it's still so vast and there's a long way to go. It's a good 10 years of IP life approximately. So it doesn't mean that other companies won't get a look in.
So changing topic, one of your key selling points is your focus on tailoring risk to the market cycle. So what recent allocation changes have you made in light of a more positive environment?
Yeah, so I think it's a good way of going back to what we previously discussed during the pandemic, when we had a lot of loose monetary policies and interest rates went down, and everyone that has worked in biotech industry and investment knows that this industry is very, very rate sensitive. So what happened in 2021, the interest rate went down to zero, more or less. The whole biotech index, especially the XBI, went up more than 150% with just a couple of months. And after that, it retracted and came back again. And what we did at that point, when we saw where things were heading, we took down our positions in small cap and moved into large cap, where the cash flow generative, more protected. And then we had a time of consolidation. And what happens then is that a lot of companies either go under, being acquired, and we have productivity burst, I think, what has been going on. We consolidate a lot of companies. The index have gone from 250, 300 companies and lost approximately 100 of companies in that index because of attrition, M&As, etc. So what we have seen of recent is that these companies that have survived and are thriving, we believe this is where the innovation happens. Biotech, everyone should be aware that majority of drugs currently approved emanate from biotech and academia. Pharma has taken on the role of being the distributor, the marketeer, and of drugs. The innovation happens in biotech. And so what we have realized and also put more effort into is investing in the smaller names, taking off some of the large cap company exposure, which we believe also have had a run up in the last couple of months and become relatively expensive according to us. So we have tilted the fund towards more small cap. And also that's one of the reasons we also have increased the basket approach. When once we move into smaller names, the inherent company risk increases. Therefore, you need to have more companies to invest in. So it's a one way of risk mitigate. And Ailsa can chip in here and have additional comments on that.
Yeah, absolutely. The team we have here is a combination of experience, really. Both of us have been working within this industry for over 20 years. So we both started around 2000, 2001 time. And Marek worked for a long period in business development within biotech, and he's worked and founded many biotech companies himself. So he brings the product development, the commercialization experience, and the valuation experience. And then I've had over 20 years following the biotech cycles, and we're combining those two knowledge bases to manage this fund. And we use all of that experience when we make decisions. But it's that that's driven our top-down decision-making process. And like Marek said, when we started as co-lead fund managers 3 years ago, we felt that the biotech capital markets were looking toppy, and we tilted to large caps. And now we feel that the biotech cycle is looking like it's bottomed out and recovering, and we're tilting to this mid-cap biotech market to increase the risk of the fund to capture those returns in a recovery.
You've just touched on valuation. Do you think that current valuations still look attractive?
Absolutely. So, like I've mentioned, we've seen this big drawdown in valuations in the sector overall since 2021. And what we've experienced in the past is that biotech tends to go in fits and starts. And the sector's had a double whammy in that, first of all, it was a natural kind of cycle of euphoria and coming out of that market after the pandemic. Then interest rates started rising, so they got another hit. And it's not because biotech companies have debt, it's because they're long-dated assets. So the expected cash flows are, say, 10 years away. And if you discount those cash flows, you're going to get a lower valuation if the rates are higher. So they've been hit by that. And then also, and this is just our view, it's not necessarily backed up with data, but we feel that the interest in the obesity names, so Lilly and Novo, have taken some of that capital out of the biotech market. And so as and when those roll over, we might see money flows back into biotech as well. So in terms of valuations, at the moment, it's still relatively depressed. So if you look on an absolute basis, we're still at the same sort of valuations that we were 5 years ago. And then if you dive into the sector, there are pockets of quite rich valuations. For example, there's a company called Vertex that's trading on an incredibly high multiple, and there's good reason for that. It's a high quality company and it's doing well. Equally, we're seeing some very attractive valuations in the small and mid-cap area, which is why we're tilting the fund out of the larger, more expensive companies into the cheaper companies.
I can add to that. And one way of looking at the index is 1.5 years ago, approximately 25% of the constituencies in the NBI index were traded and valued below cash. So they had more cash in the bank than the valuations stipulated. And that is kind of a one tell of saying that the index was oversold. Nobody believed in it. And this is very often happens in the industry. We go in very much and then down and almost crashes. And when 25% of companies are valued below, it's a very good tell for us that this is a good opportunity. We've never seen that before in essence. And we have also seen that the last 6 months prior to the US elections, very seldom we see, it's our opinion, that M&A stocks And this industry is thrives on M&A because a lot of companies get acquired, and then you have new inflow money coming into the sector. During the last 6 months prior to the election, we have not seen so many M&A deals, and people have taken money off the table. But so we hope the clarity with the election is over, we will see more attractive valuations and maybe M&As coming through as well.
So staying on that topic, you've had 25 acquisitions of portfolio companies since 2020. Do you think M&A will continue to be a key driver of returns for your portfolio, including significant acquisition premia?
Yes, we have had a really high hit rate of M&A, and you're absolutely right. We've had 25 companies out of the fund acquired since 2020. And I think actually that's a testament to Marek to an extent, because he comes from this dev and he understands what pharma is looking for and how to value these companies. So I think it's definitely a testament to his stock picking. However, separately, we generally get on average about 4 deals a year in the fund. Difficult to know which companies are getting acquired, but on average, that's what happens. But if you look at our investment presentation, you can see it's just stalls about 3 months ago. And we think this is because people are sitting on their hands and not doing deals because of the US election. And I think the reason behind that is because people don't really want to make decisions until there's certainty and clarity. Now that we have clarity, the election's now passed, we think that M&A will come back, partly also because the Competition Commission in the US, called the FTC, is currently headed up by a woman who is quite anti-M&A in biotech and tech, and especially big deals. Her concern being that this will stifle competition. 2 major deals, Gen buying Horizon and Pfizer buying Seagen, both companies that were major positions in our fund. In fact, they were top positions. She tried to stop those deals. She didn't succeed, but she still tried to stop them. So we think there's been a bit of a pause in M&A on the back of this. And now that we've had this, what seems like a Trump clean sweep, we might see a more industry-friendly, corporate-friendly FTC. And then hopefully people will have the confidence again to buy biotech companies.
We've seen an increase in equity financing over the course of this year. Do you think that the IPO window is looking stronger for 2025?
Yeah, it's very, very interesting what we have seen during the last couple of years. We had a wide open window in 2021. A lot of companies went public, and I think in some extent the market have digested those companies, and many of them were very early, maybe shouldn't have listed, but they did because the opportunity was open to them. Since then, we have had a very slow and grinding IPO market. We have secondaries have worked very well, meaning that companies that have listed and have good quality projects, they have not had any issues raising money. So, there's those who have and those who have not. But we have a lot of banks coming to us asking us what we think of certain potential IPOs. But we have also seen IPOs coming through on a very, very trickle way. But in a way, it's green shoots. So we are positive towards what might come.
Thank you. We've seen a significant rise in the popularity of passive funds in the last decade. So why do you think investors should look at IBT in preference to a passive strategy?
That's absolutely a topic that we discuss all the time and is up for debate. We should remember that when you invest in a passive fund, you're still paying a fee. So the IBB, the equivalent of our benchmark, costs just under 0.5% in fees. And we charge just over 1% in fees. And what you get from that is, 2 people who understand and have good experience in the biotech investment side and can make a decision on whether there's a big company that's overvalued, etc., and ultimately should outperform the benchmark. And that's what you're paying for. And historically, IBT has outperformed. We've had really good performance over pretty much every time metric, 1, 3, 5, 10 years. And that's what you gain from paying a slightly higher fee. The other advantage of active management is, certainly with a closed-ended fund, we can gear the trust. So over the long term, if you think equities are going to outperform or biotech will outperform in time, you're going to get that extra punch of return with a gearing facility. And then separately, the fund also pays a dividend. So you get a 4% of NAV yield every year, paid into installments, 2 plus 2%. And the way we think about that dividend, it's almost like the cash we get in from mergers and acquisitions, we give back 4% of that a year. So all of these advantages rolled up in an actively managed fund.
So, a very topical subject at the moment. How do you think Trump's victory in the US elections could impact the biotech sector?
So what's interesting is that going into the election, we felt the winds coming, and you could see that by the markets bidding up the yields in the US, the 10-year yields. So we anticipated a Trump victory. It's much more nuanced this time around. What historically has been the case is the biotech and pharma has been the political football, and everyone is complaining about pricing, etc. This time around, it was less of an issue because in a way it was sorted before the election. But one thing that we think might benefit with that Trump win is that we probably see more deregulated market, meaning that they will be allowing more M&As to happen. Pricing will be probably, compared to what a Democratic win would have been, less onerous. But on the flip side, you will see interest rates coming up, and biotech is very sensitive to that. What we can see the last 1.5 months, we have seen the yields coming up, indicating a Trump win, but the MBI index has been flat. Normally that is not the case. So in a way, it's a balanced approach. We are positive because we think M&A might trigger some interest in the sector.
And the last time Trump was in power, the sector was actually up 40%. So it did incredibly well under Trump in the past. And to Marek's point, if we get a new head of the FTC that's more corporate friendly, that should hopefully benefit biotech companies. So we're pretty optimistic under the Trump administration, definitely relative to having another administration.
And one final question for you both. How do you think rate cuts will impact your portfolio and also broader sentiment towards the biotech sector?
Interest rates, as we know, is very, very sensitive for biotech, but it should be taken in the context of derivative of the interest rates going down. If it goes quickly, then valuations will probably go up very quickly. But if the interest rates are stable or slowly coming down, should it make a big of an effect? The industry is fundamentally growing relatively rapidly. Revenues in the pharma industry grows approximately 5 to 10% a year, and that's a great tailwind for the sector as such. So near term, you can be affected by high interest rate spikes, but in the longer run, this is a fundamentally growth industry.
And on that note, thank you both for joining us today.
Thank you, Joe. Thanks for having us.
Yeah, thank you, Joe.
I'd encourage you to visit the Schroders website to find out more information about the trust, and I can particularly recommend Ailsa and Marek's insight articles on investing in the biotech sector. We also have a wealth of information available on the Kepler Trust Intelligence website, including our latest research note on the trust. Thank you for listening, and we hope you join us again soon for another edition of Trust Issues.
Past performance is not a reliable indicator of future results. The value of investments can fall as well as rise, and you may get back less than you invested when you decide to sell your investments. It is strongly recommended that if you are a private investor, independent financial advice should be taken before making any investment or financial decision. Please be aware that there can be a time lag when we release podcasts, meaning time-sensitive information may no longer be accurate at the time of publication. Kepler Partners LLP has a relationship with some of the companies covered in this podcast, which may impair its objectivity. Kepler Partners LLP is authorized and regulated by the Financial Conduct Authority.